Greetings and welcome back. This is part 2 of our monthly market monologue for January 2024. Today is Friday, the 5th of January 2024. And in today's video, we are going to review retirement plan contributions, the fact that they have increased. I want to make sure you are aware of those. And we're going to look at some of the economic data. If you haven't watched part 1 was where we reviewed the stock market for 2023. And specifically, we zeroed in on and showed you some of what we refer to as big bases and what that suggests for the year ahead. Despite the fact that the market has sold off a little bit this week, that is also something that we discussed was certainly a possibility to some extent, to a large extent, because the market had such a strong November and December. What we're experiencing this week so far is very normal. So that said, let's dive in. On the screen right now is the contribution limits for 2024, and we can see a slight increase from 2023. If you are 50 or older, the catch-up contributions are not changing, but there is a little bit of a bump in what you can put into your base contribution. So considering the fact that the year has just started, we encourage you to take a pause, look at your pay stub, and make sure you do the math to make sure that you are going to get the maximum contribution in to your retirement plan. Naturally, if you need any help, feel free to reach out to us or your financial advisor. That said, let's dive into some of the economic data. First up is the GDP forecast from the Atlanta Federal Reserve. You can see on the screen that the Atlanta Federal Reserve is suggesting that fourth quarter GDP is going to be positive 2.3%. That again is an estimate from Atlanta Federal Reserve. If that forecast is accurate, here's how this chart is going to change. As you'll see a little bit of a red bump there at the end of our GDP histogram. That would be the fourth quarter of 2023. But what do we think is going to happen for 2024? Well, as far as Hicks Associates Wealth Management is concerned, we don't issue forecasts. We do, however, look at the consensus forecasts, and one of the ways that we do that is looking at the Conference Board's economic forecast. And I've highlighted, or I've circled rather, their forecasts for the first and second quarter of 2024. You can see slight negative GDP forecast. Now, let's go back to the histogram for just a second and show you the first and second quarter of 2022. You'll recall, and you can see on the histogram, that for the first and second quarter of 2022 was barely negative. At the time, we stated that, hey, well, that's a textbook recession, 2 consecutive quarters of GDP decline. It's typically how a recession is defined. However, so far, the National Bureau of Economic Research has not declared that that time period was a recession. So if the Conference Board is accurate, and the first and second quarter of 2024 is going to be negative, well, then would that be considered a recession? Well, if the first and second quarters of 2022 were not a recession, I would certainly contend that the first and second quarter forecast that Conference Board is suggesting, that's also not a recession. But these are just forecasts, and we don't put a lot of weight in them. So let's move on. So here we have the Fed funds rate. And this is actually one of the risks for 2024 because the futures market is expecting a fair number of rate cuts in 2024. Now, the rate cuts would happen if the economy is slowing down. If the economy is not necessarily slowing down, one could argue that the Federal Reserve is not going to necessarily cut rates. So there is a risk that the futures market is pricing in too many rate cuts. And if the Federal Reserve does not cut rates the way that the futures market is expecting them to cut rates, that could certainly cause some negative reaction in the stock market. Next up, we have Dr. Copper. We've talked about this ad nauseum. You can see the red line on the right-hand side of the chart where I was really watching this to see if it was going to break down. It did break down, but it very quickly rallied. Last couple of days, the price of copper has come in just a little bit, but that's overall, we would say this is suggesting economic expansion. Next thing we want to take a quick look at is the credit index. This comes from the Chicago Federal Reserve. And generally speaking, you can see the gray bars are where we have the recession, and you can see the credit index rises as we're approaching a recession. So far, the credit index is right at that 0 line. That is not recessionary. So we're going to land the plane today by talking about some fresh economic data that just came out about an hour and a half ago. So this is the bar chart for total non-farm payroll. And here is the data point that just came out this morning. The U.S. economy added 216,000 jobs in the month of December. And the point is that beat expectations. Remember what we said a minute ago, that one of the big expectations in the stock market this year is that there's a lot of participants in the market that are expecting multiple rate cuts. Traditionally speaking, the Federal Reserve lowers interest rates when the economy is slowing down. This data point suggests that the economy is stronger than many of those pundits think it is. And this is the last point that we're going to make today. On the screen now is the unemployment data. Again, fresh data, the unemployment rate stays the same at 3.7%. But I want to highlight the black line, which is at 7.5%. That black line represents the alleged level that the United States unemployment rate would have to reach in order for inflation to be under control. This is a screenshot from a Reuters report, and they are reporting, this is dated September 7, 2022. And my main point here is to be careful what you believe when you read in the news. So according to these researchers, back in September of 2022, they argued that the U.S. economy's unemployment rate needs to reach 7.5% in order to curb inflation. Well, where is inflation now? Well, right now, inflation has come back down to 3.1%. And you can see the red line. The red line represents the 10-year average. The 10-year average for inflation is 2.7%. So you could easily argue that inflation has been brought back under control. Now, it'll be interesting to see if the Federal Reserve can keep it there. But for right now, we would certainly argue that the Federal Reserve has done a good job of bringing inflation back under control. So be careful what you read in the news. Be careful what you believe. And this is one of the reasons why we do what we do and why we always check the data for ourselves. We'll wrap up there for today. We hope you find these videos helpful. If you haven't hit the subscribe button, we certainly hope that you would. If you have any questions, by all means, reach out to us. You have our contact information on the screen. We do serve clients all over the country and manage money actively for them, as well as doing financial planning. So again, thanks for watching, and we'll talk to you next time.